It's 1942, and a wide-eyed 11-year-old boy stands in the bustling New York Stock Exchange, the air thick with the shouts of traders and the clatter of ticker tape machines spilling out endless streams of financial data. That boy is Warren Buffett, buying his first shares and igniting a journey that would turn him into one of the richest people on Earth. Today, we're diving into Warren Buffett's 5 timeless rules for building long-term wealth, principles forged from decades of investing wisdom that have compounded his fortune to over $100 billion. If you're ready to transform your financial future, stick around, because these rules aren't just theory. They're battle-tested strategies from the Oracle of Omaha himself. But let's start with the foundation that set Buffett apart from the crowd. Rule number 1: invest in what you understand. Imagine Buffett in his modest Omaha office, surrounded by stacks of annual reports, the faint scent of aged paper filling the room as he pores over company fundamentals late into the night. He famously avoided the dot-com bubble in the late 1990s, steering clear of tech stocks he didn't fully grasp, even as the market soared. This first rule is simple yet profound. Only put your money into businesses you truly comprehend. Buffett learned this early, inspired by his mentor Benjamin Graham's book, The Intelligent Investor, which taught him to treat stocks as pieces of real companies, not just ticker symbols. By sticking to familiar industries like consumer goods, think his massive stakes in Coca-Cola or Apple, he's avoided costly mistakes and let his knowledge guide sustainable growth. When you invest in what you know, you're not gambling, you're building on solid ground. And that leads us to how Buffett ensures those investments are worth every penny. Rule number 2: buy wonderful companies at fair prices. Envision Buffett at the 1989 Berkshire Hathaway annual meeting, the auditorium buzzing with shareholders as he explains his philosophy amid the aroma of fresh coffee and the rustle of notepads. He's just acquired a major stake in Coca-Cola, a company with a moat so wide competitors can't touch it. The second rule: seek out exceptional businesses, those with strong competitive advantages, like brand power or cost efficiencies, and buy them when they're undervalued. Buffett calls this getting a wonderful company at a fair price, rather than a fair company at a wonderful price. Influenced by Graham's margin of safety concept, he waits for market dips to purchase shares below their intrinsic value, as he did with American Express during the 1960s salad oil scandal, turning a temporary crisis into massive long-term gains. Quality over quantity ensures your wealth grows steadily, but holding on to those gems is where the real magic happens. Rule number 3: hold for the long term. Think of Buffett in 1965, sealing the deal to acquire Berkshire Hathaway, the sound of typewriters clacking in the background as he transforms a failing textile mill into an investment powerhouse. Decades later, that patience has paid off enormously. Rule number 3: our favorite holding period is forever. Buffett preaches buying stocks with the intent to own them indefinitely, allowing compound interest to work its wonders. He's held positions in companies like Geico since the 1970s, watching them appreciate exponentially while ignoring short-term market noise. This buy-and-hold strategy, rooted in his belief that time is the friend of the wonderful business, has been key to his 20% average annual returns over 6 decades. Patience builds empires, but timing the market's emotions can supercharge your opportunities. Rule number 4: be greedy when others are fearful. Recall the 2008 financial crisis, stock exchanges in chaos, the sharp ring of panic-selling phones echoing through Wall Street, as Buffett calmly writes an op-ed for the New York Times, urging investors to buy American stocks amid the turmoil. The fourth rule: Be fearful when others are greedy, and greedy when others are fearful. This contrarian approach has defined Buffett's success, like his $5 billion investment in Goldman Sachs during the height of the crisis, which yielded over $3 billion in profits. By capitalizing on market overreactions, buying low when fear drives prices down and selling high during euphoria, he's turned volatility into an ally for long-term wealth accumulation. Contrarian thinking sets you apart, but the true engine of wealth lies in letting your money work harder through reinvestment. Rule number 5. Reinvest your earnings. Flashback to Buffett's high school days in the 1940s. The metallic clink of coins from his pinball machines filling a local barbershop, as he uses profits not for spending, but to buy more machines and expand his mini-empire. Final rule: always reinvest your earnings to harness the power of compounding. Buffett has lived this since childhood, plowing dividends and profits back into investments rather than withdrawing them. At Berkshire Hathaway, he avoids paying dividends to shareholders, instead reinvesting in the business to fuel growth. A strategy that's turned a $10,000 investment in 1965 into over $500 million today. As he often quotes, "The snowball grows fastest when it rolls downhill the longest." With compounding as your silent partner, your wealth can multiply beyond imagination. Conclusion. So, to recap Warren Buffett's 5 rules for long-term wealth: invest in what you understand, buy wonderful companies at fair prices, hold for the long term, be greedy when others are fearful, and reinvest your earnings. These aren't get-rich-quick schemes. They're a roadmap for patient, disciplined prosperity that has stood the test of time. Now ask yourself, which of these rules will you apply first to build your own financial legacy? If this inspired you, smash that like button, subscribe for more investing wisdom, and drop a comment below with your favorite Buffett quote. Your future wealth might just thank you.